The market is currently caught in a transition phase. Two distinct pricing dynamics are colliding, creating severe turbulence under the surface of the major indices. To prepare for today's trading session on August 3rd, we have to review the chaotic price action that closed out late July. We are exiting a period of micro-driven volatility. For the past several weeks, individual company earnings have dictated the wild swings in market direction. Now, the market is pivoting. We are entering a regime of macro-driven discovery, where broad economic data will take control of the wheel. Traders who carry yesterday's earnings-based logic into today's session will find themselves trapped offside. Navigating this shift requires a new analytical framework. Before we build that framework, note that this breakdown is a personal, technical read of market geometry and data. It is for educational purposes, not prescriptive financial advice. Step 1 of our framework for today involves deconstructing the raw index price action to locate the true support levels. Step 2 requires investigating the internal market breadth. We need to see if the underlying stocks actually support the moves made by the indices. Step 3 maps the upcoming macroeconomic catalysts capable of triggering the next major directional move. Only by synthesizing the technicals, the market internals, and the economic calendar can a professional trader build a high-probability thesis for the open. This 1-hour S&P 500 chart shows severe structural liquidation closing out late July. Down in the volume profile, massive bars indicate heavy, forced selling. But immediately, buyers stepped in, driving price rapidly back up into the August open. Pulling up the Nasdaq 100 chart, we see the exact same technical posture, a heavy downward trend interrupted by a sudden, violent upward spike on the right edge. And checking the Dow Jones Industrial Average confirms the pattern is market-wide, a deep plunge met instantly by a vertical rebound. This uniform pattern across all three indices defines a classic V-shaped recovery regime. While V-shaped bounces look incredibly bullish on a daily chart, they lack foundational base building. Because the recovery was so fast, the market formed no consolidated support levels on the way back up. This leaves the market's technical structure fragile. If sellers return to retest those recent lows, there is no structural floor to stop the fall. The index charts project an illusion of strength. To see the vulnerability hiding underneath, we have to look past the top-line numbers. This market heat map shows chaotic distribution, what we call bifurcated internals. Bright green clusters sit right next to deep red zones, proving there's no unified buying. You have Amazon up over 15%, directly adjacent to Apple, down over 7%. Amazon's massive outperformance is single-handedly buoying the consumer cyclical sector, while Apple actively acts as a drag on consumer electronics. We can see another extreme divergence here. Google rising nearly 7%, directly contrasting with Micron Technology falling almost 6%. Capital is behaving reactively. It is chasing specific corporate earnings profiles, rather than flowing into equities on a general bullish macroeconomic tide. This creates a dangerous illusion of breadth. Because the massive market caps of a few tech giants heavily skew the S&P 500, the overall index looks far healthier than the average stock actually is. A bounce supported by only a handful of megacap pillars is unstable. It is highly susceptible to collapsing if a broader economic shock hits. On the economic calendar, market attention pivots forcefully to the macroeconomic data scheduled for release. We can isolate the primary volatility catalyst for August 3rd down to a precise hour, waiting on the US ISM Manufacturing PMI print. The red folder designation notes a high-impact event. It represents a data point capable of causing immediate, systemic repricing across the market. The ISM Manufacturing Index tracks purchasing managers' activity. Institutions use this forward-looking indicator to gauge the actual health of the broader economy. This connects directly to the fragile technicals we mapped. We know the indices are propped up by a few heavy tech stocks with no structural support below them. This PMI release is the ultimate stress test. It will either provide the economic validation to hold the bounce or shatter the support levels entirely. Combining the fragile chart structure with the macroeconomic timeline gives us the likely intraday sequence. Expect the market to exhibit constrained, choppy price action heading into the session open. This chop occurs because institutional capital is waiting on the sidelines. They refuse to commit heavy size before the macro data is revealed, which builds stored tension in the market. Furthermore, because the market internals are severely bifurcated, there is no natural underlying momentum to drive a trend prior to the news. Any price movement prior to the ISM print is essentially noise. The true session begins exactly when the data is released. This gives us two branching scenarios. If ISM manufacturing data comes in weak, it proves macroeconomic deterioration. The tech facade crumbles, failing the V-shaped recovery and triggering an aggressive retest of late July lows. Conversely, strong ISM data proves macroeconomic resilience. Strong data provides the necessary macro tailwind to unify the divergent sectors. Broad participation will push the indices sustainably higher. For August 3rd, tactics are clear. Today is a hurdle day. Risk management is paramount. Professional traders do not gamble on predicting the data. They stand aside, measure the print, and trade the market's reaction to the facts.